It's been a banner year for IPOs. So, what do all these market debuts? We got another one today. What do these market debuts say about the stock market at large? Well, let's find out from Ross Gerber. He's the CEO of Gerber Kawasaki. Thank you for joining us.
Thanks for having me.
All right, so let's go big picture. Whenever we have a hot IPO, especially if it comes from a tech company, immediately the comparisons go back to the dot-com bubble. So I'm wondering how you're feeling today when we got this DoorDash IPO, what, surging 80% in its opening trade?
Yeah, it's crazy. And I grew up in my career during the dot-com era. I was lucky enough in some ways. So I remember it very clearly because it was a really crazy period of time. But it really doesn't remind me of this period of time because during that period of time, the economy was very good and there was a lot of tech innovation like today, but it made more sense in a way, and the valuations were much higher. Today, I think we have a pretty bad economy, and what we're seeing is just a tremendous investor demand for new names that represent the future instead of the old names in the stock market, which everybody's pretty tired of buying and selling Apple and Google and Microsoft. So I think what we're just seeing is a lack of new ideas and companies. Now they're coming to the market and there's just tremendous demand.
So with a market valuation of $70 billion out of the gate, which is what, more than quadruple what DoorDash got in its last private funding, does that make sense?
No, of course not. Once again, I remember when Home Grocer went public, and I used to use Home Grocer, and I thought it was just great food delivery. And food delivery is the absolute worst business. I'll say it again. It's the absolute worst business. Nobody's ever made money on it. It's another home grocer. Nobody will ever make money doing it because it's super inefficient. It really is almost like anti technology. You use technology to create an inefficient thing. So sending people to go pick up groceries or sending people to go pick up food, it's just not that profitable. And so none of it makes any sense to me.
Yeah, I was just looking at some numbers with a $70 billion market cap for DoorDash. I took a look at Wendy's. It has a what, $5 billion market cap. Chipotle has a $37 billion market cap. Domino's has about a $1.5 billion market cap, and Dunkin' Brands has a what, almost a $9 billion market cap. So with DoorDash having a $70 billion market cap, it's worth more than Wendy's, Chipotle, Domino's, and Dunkin' Brands combined.
I think you're making a great point. Like Domino's is a really good stock. It's a really good company and it's a delivery business. But where do they make the margin? They make a margin in the pizza. You know what I mean? And it's a profitable, great business. Okay. So it makes a lot more sense to own Domino's than DoorDash, which basically goes, picks up the pizza and then drives it to you and has to pay the driver, it has to pay for gas, it's got to pay for the car. And then it's like this time that it takes and the interface and all the staff. And I'm like, how do you do this in a super competitive business where you charge $3 or $4 a ride? And the restaurants aren't going to do this forever either. You have to remember, restaurants don't like delivery as their main source of revenue. It's lower margin for them than people coming into the restaurants. And so I think longer term, delivery is obviously here, but I just don't see it ever panning out to being a great business.
And I'm wondering if we broaden out the discussion in terms of IPOs and we take a look at the hot tech stocks, some of them IPO this year, some of them a couple of years ago. I mean, today we got a downgrade from JP Morgan of DocuSign and we got a downgrade of Zoom. I took a look at these stocks. DocuSign is up 200% year to date. Zoom up 468% year to date. Snowflake up 208% since its IPO. Palantir up 262% since its IPO earlier this year. So what do you make of the run in these tech stocks? Has it gone too far, too fast? Are we in crazy town?
Oh, we're definitely in crazy town. But, you know, so markets are not that efficient. There's this sort of theory that markets are efficient, all prices are correct. Well, that's actually not so true. And that's why investors like me exist because we take advantage of this. So I think what we're seeing right now, as I said before, is that if you're a new name, a new opportunity, many of the funds and institutional investors want to put these new names in their portfolios, and they're doing it without taking a look at valuations. I mean, a perfect example is now everybody talks about price to sales and nobody talks about price to earnings, and they're talking about price to sales numbers that used to be what we used to talk about as price to earnings numbers. Okay. So one of the things I've learned in my 27-year career is when things start, moving away from making any sense, it's not you. Okay. It's the market. Now, it's not to say that that won't continue for some time, but this will end a violent, horrible end as soon as the Federal Reserve comes back to business. So, so keep in mind, when Jerome Powell comes back from his sleep, these stocks go down heavy,
All right.
very, very heavy.
Well, thank you for those viewpoints. That is Ross Gerber. He is the CEO of Gerber Kawasaki. I'm Conway G. Gittins, and this is Reuters.